How's it going, everyone? Welcome back to another episode of the Investment Hound podcast. On today's episode, we're going to be starting a new series where Grandad and I build a portfolio using all of the information we've talked about in the previous podcast and also the information from his checklist. So this is how it's going to work. I'm going to pick shares and Grandad's going to pick shares until we have a combined total of 14 shares in our portfolio, and then we're going to chop and change and reanalyze them and do whatever we need to do in order to build a profitable portfolio. So on today's episode, we're going to be going through all the indicators I used to pick my first 3 shares. Then on next week's episode, we're going to be going through the 3 shares, okay? Originally, we had recorded this whole episode in one go, but it was way too long. So we decided to chop it up and make it easier to consume for you guys at home. I really enjoyed this task. It was the first time I've ever done anything like this. And I definitely learned a huge amount. Okay, so hopefully you beginners, investors at home like me, will learn as I'm learning through this portfolio. So enjoy the podcast. Okay, so for the indicators, what I did here was I followed...
The indicators are the things that you use to decide whether the share is worth buying or not.
Yeah.
And they're all financial type indicators.
Yes.
Yeah.
And what I did here was I used... Well, sorry, not necessarily all of them are financial indicators. The main ones are financial indicators, but there's also a couple of economic ones and stuff like that as well.
Okay.
But I got these from the checklist in the Grandad's book, for the listeners at home, in Grandad's book, and also from what we discussed throughout the previous podcasts. Okay, so the first one is the dividend yield. So I didn't pick anything that had a dividend yield of less than 6%, as I wanted to make sure I would get a good return on my investments, regardless of how the share price does. The second one was the payout ratio. So anything above 50% of a payout ratio I ignored, as I wanted to make sure that the companies would have enough money to be able to reinvest it back into the business. So I only pick companies with less than 50% payout ratio. The PE ratio, I didn't use any benchmark figures here. The way I did it with the PE ratio was I made sure it was below the industry average. So each industry has a different PE ratio. So I made sure that the shares I picked were below the industry average, which would mean that they'd be cheap compared to the industry average or other companies within that industry. The next is the EV to EBITDA ratio. So it's enterprise value to earnings before interest, taxes, depreciation, and amortization, which is a popular valuation metric used to determine the fair market value of a company, indicating that the company is appropriately valued within the industry. So the next one I used then was the RSI, which is the relative strength index, which is an indication of whether a share is a sell signal, a neutral signal, or a buy signal. And I wanted to make sure it was below 60. So from my understanding, 0 to 40 is a buy signal, 40 to 60 is a neutral signal, and 60 plus is a sell signal. So anything that was neutral or below, I would buy. The analyst's rating then. So when you go and you have a look on all the different tools such as Yahoo Finance, Simply Wall Street, TradingView, there'll be all analysts' opinions on it. And these opinions are about a combination of 25 analysts' opinions on the company. So I would always make sure the analysts were rating it either a buy or a strong buy. And then the last one was, where is the company located? So I would only invest in companies that would be located within strong, stable economies, meaning I ignored companies that were operating in places like China, South America, Africa. I didn't, or poorer countries within Europe as well. I just didn't want to. I didn't want to have to deal with any kind of uncertainty that may arise from geopolitical tensions or anything along the lines of that. So they were the indicators that I used when I was picking these shares. So what's your take on those indicators, Grandad?
Okay. Well, I'm, as you know, a dividend investor. And I looked at my portfolio for last December, and I was earning 7% on my portfolio.
Nice.
Now, that's based on the original cost of the shares. So if I bought a share for 100, I was getting 7 on that. That share might now be trading at 140 or 130. So normally dividend yields are shown based on the current market price of the share. But for an investor, he really needs to be looking to see what's the dividend compared to what he paid for the share, which is static. I mean, what you paid for the share is static, whereas the market price is changing all the time. So I am earning 7% on the original cost of the shares. Now, that is very high. It's, if you like, unusual. And it may or may not work out in the long run. However, I would invest in shares that are 5% plus rather than 6% plus. Certainly, the higher the dividend yield that you invest the share in, the more likely the dividend won't survive. So I'd be slightly more conservative than you on that. I'd go 5% plus. Now, I might be tempted to go into a 6% one, but it wouldn't be my minimum. My minimum would be 5%. And when I started investing, going back 10, 15 years ago, my target was 3.5%. But companies are paying higher dividends nowadays. So that's why I'm now up at 5 and you're up at 6. And by the way, that's a matter of risk appetite. And, your risk appetite, being younger, okay, is going to be slightly more exciting than mine.
Yeah. The next one was the payout ratio. So mine was anything below 50%.
Yeah, no, I'd agree with that. But your description of the payout ratio would be, which is valid description. You said you wanted to make sure that there was enough retained profits each year that they could reinvest in the business to keep the business going. I used to always look at the payout ratio to make sure that if the profits declined, they could still pay out the dividend. In other words, they might next year have a bad year, but then they'd use a payout ratio of 70% to tide them over rather than cut the dividend. Whereas if they were up at, we had one particular company in Ireland, a newspaper company, and their payout ratio was 85%. They paid out 85% of the profits. And everything was going wonderfully well until the newspaper industry, with the internet and all that coming in, newspaper industry went through bad times, and they had no rainy day money left to see them through because they had spent all the money on dividends. So effectively, I don't like companies that pay out more than 50% of the profits. In fact, the Irish banks traditionally, in the good times, paid out 40%, and they're back to paying out 40% now again. So 40 to 50% is acceptable, 50% on the edge as far as I'd be concerned, 40% comfortable, and 30% robust, let me put it that way to you.
Okay.
So I would just slightly describe it as it was the sustainability of the dividend. That's what I was making sure of by saying they shouldn't pay out more than 50% of the profits. But your description of that they need to invest is also, with the other 50%, is also a valid description.
Okay. So the next one I had then was the PE ratio, which is below the industry average. So I didn't pick one benchmark figure. I analyzed it based off the industry in which they're operating in.
Yeah, and that's a very accurate way to do it. I don't do it that way, and maybe I should do it that way, but I'm lazy. Okay, I kind of say European shares with a PE ratio of less than 10 or 12 are cheap, and US shares, excluding the technology giants, the famous 5 or the magnificent 7 they used to call them, excluding those, the market P ratio in the States is around 15. So I'd be saying if I could get less than 15 in the US and less than 10 or 12 in Europe, that tells me the share price is trading cheaper than normal. And
Well,
that's the ones I chase then.
You might be interested to know, actually, okay? So one of the tools I used was a tool called Simply Wall Street.
Yes.
And if you sign up, if you make a free account, you can actually check the PE ratio. They already have it done. You can check where the company lies within the average of the PE ratios. Yeah. So that's how I did it. Anyways.
And my brother lives in Florida. I think he uses that website too.
It's very good.
And every now and again he sends me an article and he says, look at that article there, you know.
Yeah, it's very detailed, to be fair. So the next one then that I used was the EV to EBITDA ratio.
Yeah, that's a more sophisticated version, I think, of the price earnings ratio. You know what I mean? It's just a more sophisticated version of it. And so I just stick with, I'm lazy. I stick with the price earnings ratio. But a lot of stockbrokers use the other one.
Well, one thing you said there actually about the PE ratio that was interesting is that you said you analysed it not by industry average but by by market or continent. You said that you looked at it within Europe.
Yeah.
So that's also a valid way of doing it as well. Like you don't have to just do it by industry. You can also do it by region and.
Yeah, and the other thing you know when you were talking about risk appetite, you were talking about not going into the emerging markets, you know, not going into Asia, being a little bit worried about Eastern Europe, leaving Africa off the system and things like that. Right? I'm the same as you on that. And of course, the PE ratios. Then, no matter what they are in Nigeria, I don't invest in Nigeria. I think you're being a bit harsh by saying you wouldn't invest in China. At your age, I wouldn't invest in China because, you know, I don't trust what the government might do to my company.
Yeah.
You know, because they're a totalitarian government. And they might decide, we don't want that company trading anymore in China and kick them out. So I don't invest generally in those kinds of companies. But Taiwan, you know, I've never given it any thought, but I'm not sure whether I'd invest in it, but there might be somewhat a better case for Taiwan. I don't know.
Well, I wouldn't go near it because it's looking likely that China is going to
I understand
move forward. So
I haven't gone in. I haven't gone in either, Adam. I haven't gone in either.
So then the next indicator I used was the RSI. So I wanted to make sure that this was below 60.
No, I don't agree with that.
Okay.
Let me first of all give you the facts, which I think are slightly more accurate than what you said. 30 is a buy signal. Is a buy signal.
All right.
And 70 is a sell signal. Therefore, 50 is the midpoint. So being a conservative investor, I said I wouldn't buy anything unless RSI was 45 or lower. Okay. And I would sell definitely when I got to 60, 65. Maybe because I'd be afraid to wait till I got to 70 in case it crashed then when everybody else sold.
Yeah. I think actually in some of the shares that I picked, I didn't actually use the RSI in all of them. I think a couple of them, or one of them, I might have left it out. Anyways, the next one was the analyst rating. So I would only buy one if it was a buy or a strong buy.
Generally that would be my view as well, because you see, you can do, and as I said to you, I'm a lazy investor, so I don't have to sit down and download the accounts of a company and start off and say, where did the profit come from? What's the margins? You know, what are the costs like? Are they paying too much tax? You know, have they enough money in the bank? Are they overborrowed? And go through all of that shenanigans and do that from Western Europe. When in fact the analysts, that's their business. They do that. And not only that, they ring the company or visit the company and try and squeeze a bit of information out of them, you know. And they've done all the other companies in the same sector. You know, they tend to specialize by sector. So why not just rely on what the analysts are saying? So I'm very much in favor of that. It simplifies investing hugely. And in the book, you'll notice that I have done very little technical stuff because of that. I don't have to do the technical stuff if you're going to be heavily influenced by the metrics and by what the analysts say about the metrics, essentially. I think the analysts and looking at what the analysts are saying is a critical part of your decision-making toolkit.
Correct me if I'm wrong, Grandad, but it is important to note that the analyst's decision can change overnight, though, can't it?
Oh, it can, yeah.
So,
but it'll change overnight because circumstances have changed. So that risk is there no matter what. It's just that the analysts who are smarter and more clued in than you got caught offside. But I believe in those circumstances, Adam, that you will be even more caught offside.
Yeah. So then the last one here, okay, was that. And I'm going to talk about this indicator when I talk about the learnings, okay? But the last one here was that I wanted to make sure that the company was located within a stable economy. So that's not a technical indicator, but that's more of a
but that's what led you
political indicator.
That's what led you into Australia and Europe and the UK and Ireland and Canada and the US. That's what led you into that. So we obviously agree on that.
Yeah. However, one thing I think is important to note here, okay? So now that I'm going into the learnings, I wanted to, when I was analyzing these shares, I did play it as safe as possible, okay? So what I would do is I would discard any companies using a screener tool that didn't meet any of these indicators, right? But as I was doing this, I kind of realized that if you want to make some proper gains, within the markets, is that sometimes within the financials, there has to be something wrong. Isn't that right?
Yeah, like the situation is very simple, okay? These metrics and what the analysts say are considerations you take into account when you're going to invest in a share. But you're not jailed by them. You can decide to break out of jail and say, to hell with that. I'm going to back my instinct or I'm going to back my gut. A lot of people make money backing their gut, and you're probably not going to get all the metrics, as you say, in line with what you want. But if there's one or two that you feel are not as important, like for me, the dividend yield is important and the payout ratio is important and what the analysts say is important, right? But other ones mightn't be as important, as we'll discover when we talk about some of your shares later.
Yeah. The other learning was that the last indicator that I just discussed there, which was making sure the company was located in a stable economy, what I really should have done, and I think a more accurate way of determining what I was trying to do here, which was making sure that there would be no, or that the risk of any kind of geopolitical tensions or recessions or anything like that, was I should have made sure that the company's profits were coming from a stable economy rather than the company's headquarters being located in a stable economy. Because we can have, let's say here, an Irish coffee company that's selling coffee in Taiwan or Nigeria or South Africa or somewhere like that, but they're located here in Ireland. That's what I was looking at. But really I should have been looking at making sure that that coffee company was located here in Ireland and selling within Ireland into the UK, into the US, into Australia and Japan or wherever. That's really what I should have done.
Well,
there.
I think I find that a little bit harsh.
Okay.
What I mean by that is, right, would my brother in the States, who's a professor of economics and obviously a much smarter guy than I am, okay?
Better looking as well, Grandad.
Absolutely. Even though he's a half an hour older than me, my twin brother. But anyhow, what I'm going to say to you is that he said, I wouldn't invest in a Chinese company when you can invest in Caterpillar. And I'm kind of saying to myself, Caterpillars? No, Caterpillar the Inc., he said. Caterpillar the company. Because Caterpillar the company sells, I think it's machinery. Okay. They sell a huge amount of machinery to China. So by investing in Caterpillar, I have a certain degree, or he has a certain degree of comfort that it's a local American company, but it's taking advantage of the fast-growing Chinese economy. And if the Chinese economy wants to continue as a fast-growing economy, he's betting that they'll continue to want machinery and they'll want the best machinery, and he maintains that Caterpillar's company has the best machinery. So I think there's arguments to and fro and in and down and up. But the idea of risk appetite, let me ask you a simple question. Would you, if I gave you money to go and get skydiving, would you do a skydive?
Personally, no. Because I just don't see what the thrill is of jumping out of a plane. But I'm sure a lot of people my age would be.
Well, you know what happened in Dublin yesterday, do you?
I did actually, yes. I saw it on the news this morning.
The helicopter flew between the two small electrical towers and dropped 3 people out of the helicopter, 2 of whom did skydiving, and the third guy had a camera, working on it. So there are people who will do skydiving, and there are people who won't do skydiving. And that's an understandable thing. I mean, I wouldn't do skydiving at my age, okay? But your first cousin, Nadine, who lives in Seattle, she has done skydiving, okay? So effectively, what I'd be saying to you is that, your risk appetite is a matter of personal choice. And some people would be quite happy to invest in Taiwan and others wouldn't be. And you have to make those decisions clear and honestly and, consciously when you're investing. Where do I draw the line?
Yeah.
That's the decision you make.
So moving on then, just for the people at home that are interested in going into the markets, the tools that I use to analyze these shares, the first one was TradingView. So they have a screener tool, which is great because you can just filter out all the companies by the indicators. So I can literally insert 6% dividend yield, 50% payout ratio, and so on into these indicators, and it will just show me all the companies straight away. So that's great. That saves a huge amount of time. The second one was Yahoo Finance. And then the third one was Simply Wall Street. And the reason why I used 3 of them was because, and this is something I'd said to you a while ago, Grandad, when I first started dabbling in the market and, started to do research and stuff like that. I remember asking you, Grandad, how come on Yahoo Finance it says that the dividend yield is 5.6, and then on Google Finance it says the dividend yield is 5? And you were like, it doesn't matter. You just take the average of all the 3 tools. So it's important to cross-check among the tools and make sure that they're all roughly within the same bracket. And there's not one that says 3% and one that says 8%. They're all within the same region, I suppose. So they were the tools I used anyways, in case anyone wants to go out and do their own research. So
yeah, and just be careful. Sometimes the ratios are prospective, and sometimes they're trailing. And sometimes they work out the price-earnings ratio based on the last published earnings. And sometimes they work out the price-earnings ratio on what they think the earnings will be in the future. You're going to get 2 different answers. And you're either going to have to work on the prospective one or the trailing one. Obviously, if you have a lot of respect for who's doing the prospective one, you might actually work on the prospective one. Otherwise, it's always safer to work on what's the factual one. If in other words, what was the earnings last year compared to the current market price.
And correct me if I'm wrong here, Grandad, but the PE ratios that you generally see are all trailing 12-month PE ratios.
Yes. But
so
then
that's the more commonly used one.
The analysts will also tell you what they believe the earnings will be next year.
And that will be labelled as forward PE ratio, FWD. It'll be in brackets beside it, won't it?
Yeah, and the other interesting thing is, the other thing that I look at that's not a metric that you have mentioned is sales revenues. I have a difficulty investing in companies whose sales revenues are falling. That's the business they're in, selling their product. And if they can't continue to sell more product and end up selling less product, that gives me the shivers.
That's very true. It's like do you know the billionaire Mark Cuban? Do you know him?
No, I don't know any billionaires, Adam, other than yourself, who's on the way to being a billionaire.
That's a good answer. But he always says that every business at the end of the day is just sales. Because if you can't sell your product, then you don't have a business.
Well, it's a key indicator, but margin is important as well, and cost control, and there's lots of different things, but it is a very, very important part of business. Yes.